88 cents a share. I mean, Wall Street analysts were guessing, what, 63 to 64 cents?
Yeah, 64 at the absolute high end. Interface didn't just beat their Q2 consensus, they completely obliterated it.
Right. We are looking at a massive top and bottom line surprise for the quarter. Adjusted earnings of 88 cents per share is just a huge leap from the 55 cents they reported in this exact same quarter a year ago.
Oh, absolutely. And revenue came in at $395.7 million, easily topping that $390.69 million consensus.
Which is, a 5.4% year-over-year increase, or I guess 3.8% if you strip out the currency fluctuations.
Exactly. And management took that momentum and just immediately rolled it into their forward guidance. They raised the full year 2026 revenue target to a really tight window of $1.455 billion to $1.485 billion.
Wow. So they aren't pulling back at all.
Not even a little. Third quarter revenue is projected between $370 million and $380 million, and they took the full year adjusted gross profit margin expectation up to 40.6%.
And the market loved that, obviously.
Oh, it wasted zero time digesting this. The stock surged over 5% in pre-market trading, blew right past its previous 52-week high, and eventually printed an all-time high of 37.75.
That's wild. So for anyone tracking this, Interface is now up like 26% year to date,
Right.
and over 42% trailing 12 months.
Yeah, the headline numbers are spectacular. But buying an industrial manufacturing stock at an all-time high?
Right, you got to be careful there.
Exactly. It requires looking really closely at the mechanics under the hood. For retail investors trying to figure out if this rally has actual lasting power, you have to dissect how they managed to squeeze out these massive gross margins this quarter.
Because the profitability profile is the real story here, right? I mean, GAAP gross margin rose to 45.0%, up from 39.4%. Adjusted gross margin expanded by a staggering 524 basis points.
It's huge. And adjusted EBITDA rose 35.2% to $87.7 million.
Seeing a margin jump of 524 basis points in a single quarter for a company that, makes heavy physical industrial goods, that is incredibly rare.
It is. That scale of expansion really demands scrutiny. You have to separate the structural, recurring reality of the business from any one-time windfalls.
Right, because there was a windfall here.
Yeah, digging into the SEC filings, 393 basis points of that bump came directly from a $15.6 million IEPA tariff refund.
Okay, so to put that in practical terms for everyone listening, that tariff refund is a lot like putting on your winter coat for the first time in December and finding a crisp $20 bill in the pocket.
That's a great way to look at it.
It's a fantastic one-time surprise. It pads your wallet for the day. But you cannot build your monthly household budget assuming you're going to magically find another $20 bill in that coat pocket every single morning.
No, you definitely can't. It's totally non-recurring.
Right. So what happens when we take that away?
Well, stripping out that 393 basis point windfall leaves you with 131 basis points of pure organic operational improvement.
Okay.
And that is the number that matters. That remaining expansion was driven by a favorable price and product mix alongside tangible manufacturing efficiencies right on the factory floor.
So in the commercial flooring space, finding 131 basis points of margin means they're actually getting better at running their machines.
Exactly. They are optimizing the raw material yields, they're reducing scrap rates on the backing lines for their carpet tiles, and just managing their energy input costs a lot more effectively.
So that 131 basis points is like the permanent raise at work.
Yes, exactly.
That is the structural improvement proving the underlying business is getting fundamentally stronger, completely independent of any regulatory refund out of Washington. They've proven they can make the product more profitably.
Which is huge.
But a great profit margin doesn't mean much if the volume isn't there to support it. So the next logical question is where exactly this organic growth is coming from, because the regional dynamics are kind of shifting, right?
They are. I mean, the Americas segment is still the undeniable heavy hitter.
Yeah.
They brought in $247.7 million in net sales, which is a 3.4% increase, and generated $61 million in operating income.
Okay, solid.
But the EAA regions, that's Europe, Asia, Africa, and Australia, is where the top-line velocity is really accelerating right now.
Oh, really?
Yeah, they saw 8.8% growth there, hitting $148.0 million with $13.9 million in operating income.
Wow. Okay, so what's driving that broad-based global success?
It really comes down to CEO Laurel Hurd's One Interface strategy.
Okay, one interface. It sounds like, standard corporate jargon.
It does sound like it. But it's actually a fundamental restructuring of their go-to-market mechanics.
Hmm.
Historically, a company like this operated in total silos.
Right, like different departments barely talking to each other.
Exactly. You had one sales rep dedicated entirely to selling carpet tiles. A completely different rep, carrying a totally different quota, was handling resilient flooring or the rubber segments.
Wait, so they were essentially competing against each other for the exact same facility manager's budget.
Yes, representing the exact same parent company. The inefficiency of that old model was staggering. The buyer had to navigate multiple points of contact just to outfit a single building.
That sounds like a nightmare for the client.
It was. So under the one interface model, they have combined those selling teams. Now a single unified team walks into a client meeting, unrolls the blueprint, and can outfit the entire facility.
Oh, that makes so much more sense.
Right. They are winning by strategically diversifying their product tiers within a single pitch. So they offer highly accessible, budget-friendly price points with their open-air carpet tiles and 3mm LVT.
Luxury vinyl tile, right?
Yep. But they position those right alongside premium high-margin innovations like the Noravant rubber platform.
It's a classic land and expand approach, but executed at the architectural level.
Exactly.
You get the client in the door with a highly competitive product for the massive high-traffic corridors, like the sheer volume plays. Then, seamlessly, you upsell them on the premium rubber for the specialized areas where they need, extreme durability or slip resistance or acoustic control.
Like a surgical suite or a high-end boardroom.
Right, exactly.
And that tiered approach is the exact mechanism driving the favorable mix we saw in that 131 basis points of operational margin expansion.
Because they're blending the margins.
Yes, by capturing the value-oriented volume and the high-margin premium placements on the exact same purchase order, they are maximizing the profit margin per square foot on every single project.
That's brilliant. And we have to look at the specific end markets buying these products, too. Interface is heavily leaning into non-cyclical sectors, specifically healthcare and education.
Right, those are huge right now.
Yeah. In the K-12 space, there is a massive wave of facility modernization happening. And then in higher education, universities are locked in this, arms race to upgrade student centers and academic buildings just to attract enrollment.
And those non-cyclical segments provide a critical structural buffer against macroeconomic volatility. I mean, think about it. A major hospital network does not halt the renovation of a critical care wing just because the Federal Reserve adjusts interest rates by 1/4 of a point.
No, they're not watching the Fed for that.
Right. The funding for those projects, the timelines, and just the sheer operational necessity keep that demand highly insulated from the broader economic cycles.
And beyond that non-cyclical base, Interface is aggressively capturing premium corporate demand. We are seeing Class A offices actively upgrading their spaces to enforce return-to-office mandates.
Oh, the RTO push is real.
It is. And if a Fortune 500 company is going to mandate that employees commute 3 or 4 days a week, they need a premium, highly designed environment to actually justify the friction of the commute.
You can't ask people to commute for an hour to sit in a dingy cubicle.
Exactly. They simply cannot bring workers back to stained 20-year-old broadloom carpet. The physical space has to be an asset.
It really does. So capturing a better mix of products, selling to more resilient end markets, and executing more efficiently with a unified sales force, it's a phenomenal narrative.
It is.
But with a stock price printing all-time highs above $37, the scrutiny on valuation has to intensify.
Okay, yeah. I'm going to play devil's advocate for a moment here, because if you are looking at deploying capital right now, the first question is whether this is a classic valuation trap.
Fair question.
I mean, the stock surged aggressively toward the 40.50 fair value target set by some of the consensus models, and we just talked about the Q3 revenue guidance midpoint being $375 million. Doesn't that leave incredibly little room for another massive top-line surprise? Is all the upside already baked into this all-time high?
It is a vital question. To answer it, you have to look past the income statement and evaluate the foundation on the balance sheet. Interface is sitting on $81.5 million in cash.
Okay, that's a good cushion.
It is. And the balance sheet is remarkably clean. They're showing a net leverage ratio of just 0.5x.
Wait, let's pause on that 0.5x leverage. Because for an industrial manufacturer operating physical plants and managing global supply chains, that is incredibly low.
It's almost unheard of.
Right. Most companies in this heavy asset space carry significantly more debt just to maintain their daily operations and manage working capital.
Yeah, the math behind that ratio is really compelling. They have net debt of just $122.8 million, measured against $250.5 million in trailing 12-month adjusted EBITDA. But the metric that really stands out is their return on invested capital, or ROIC, which is sitting at a stellar 19.8%.
Oh, wow. So for context for everyone listening, that means for every dollar they plow back into their factories or their sales teams or their R&D, they are generating nearly 20 cents of profit. That indicates highly efficient capital management. They aren't just throwing money at growth and hoping it sticks. They are generating high-quality returns on the capital they deploy.
And when a company can generate nearly a 20% ROIC while maintaining just a half turn of leverage, they give themselves immense financial flexibility for future capital allocation.
Like what?
Well, whether that's strategic M&A, share buybacks, or dividend growth. Couple that with their order backlog being up 22% year to date, and they have tremendous visibility into their future revenue pipeline. The orders are already in the system.
Okay, but does a clean balance sheet and a strong backlog justify buying in at an all-time high, especially considering the tighter guidance moving forward?
You do have to price in the reality that Q3 margins will normalize. Management was completely transparent about this on the call.
Right, the $20 bill in the coat is gone.
Exactly. The tariff refund is gone. The baseline resets. Furthermore, leadership explicitly called out a dynamic and uncertain global macro environment.
Yeah, you always get nervous when management throws out the word uncertain.
For sure. The cushion for error at these price levels is undeniably thinner than it was when the stock was trading in the 20s.
So if you're buying here, the market is basically pricing in near flawless execution from the One Interface team from here on out. They have to continue converting that 22% backlog efficiently without any major supply chain hiccups or labor disruptions.
Yes, but while the margin for error is smaller, the valuation multiples counter the idea that the stock is completely priced for perfection.
How so?
Look at the PEG ratio. The price to earnings to growth ratio is sitting at an incredibly low 0.34.
0.34.
Yeah.
Okay, so a PEG ratio of 0.34 essentially means the stock price is driving the speed limit, but the company's underlying earnings are doing 100 miles an hour.
That's a great analogy.
The earnings acceleration is drastically outpacing the premium the market is charging for the stock.
Exactly. A PEG under 1.0 is generally considered undervalued based on near-term growth projections. At 0.34, the market isn't just paying a higher premium for the same stagnant earnings. The earnings power is robust enough to justify the stock price appreciation, suggesting the fundamentals actually still have room to run.
Okay, so the financials are clean, the leverage is practically non-existent, and the valuation relative to growth still looks compelling despite hitting all-time highs. But there is one final structural advantage Interface has built over the last decade that we need to touch on.
Oh, absolutely.
It's something that rarely shows up on a standard balance sheet, yet it might just be their ultimate moat for winning future corporate contracts.
You're talking about the ESG initiatives.
Yes.
Interface has an aggressive, almost militant commitment to its sustainability metrics. They are currently sourcing 79% of their manufacturing energy from renewables.
Which is massive for an industrial manufacturer.
Massive. And they have successfully cut greenhouse gas emissions by 36% since 2019.
And their ultimate target is becoming a carbon-negative enterprise by 2040. But here is the absolute most critical detail of that pledge, and you have to understand this. They are doing this without the use of carbon offsets.
And that distinction changes everything in today's corporate environment.
Right, because anyone with enough capital can just buy offsets.
Exactly. A company can run a highly polluting factory and simply pay a third party to plant trees somewhere else to balance the carbon ledger. It's just a financial transaction.
Right, it's accounting.
But physically engineering your supply chain, reformatting your raw materials, and redesigning your manufacturing processes so the product itself extracts more carbon than it emits. That is an entirely different tier of operational excellence. It requires fundamental material science innovation, not an accounting trick.
And this brings us to the final thought we want to leave you with today. As massive corporate and government clients increasingly mandate strict ESG requirements for their own supply chains, does Interface's sustainability leadership give them a permanent, unassailable edge in winning lucrative Class A contracts?
It really might. When a major healthcare network or a Class A office building is trying to hit its own net zero targets, everything they bring into the building counts toward their Scope 3 emissions.
And flooring is a massive physical part of a building's interior footprint.
Exactly. So picking a vendor that is already marching toward being carbon negative without offsets isn't just a nice public relations story for the buyer anymore. It becomes a strict procurement requirement to meet their own climate pledges.
It transitions sustainability from a nice-to-have bullet point on a marketing brochure into a hard barrier to entry for their competitors. It's like they aren't just handing you that winter coat with the $20 bill, they've engineered a coat that actively generates its own heat. Does this ESG moat make their revenue base untouchable? Follow the show for daily earnings coverage.